Good evening, ladies and gentlemen. I'm Colonel Shabbar Shahid. You can call me Dr. Shahid. I welcome you all to this lecture on the topic The Basics of Finance and Investment. What I'm going to speak today is very basic and you all must be aware of the subject. But I shall try and explain in a manner which will probably make you think. It will change our perspective or the way we look at finance, and ultimately it is going to help us in managing our own finances in a better way. So coming to the topic, number one, the purchasing power and its implications. Then something about savings and investment. Then we shall try to discuss what is risk and we will try to analyze what is risk. Then something about liquidity, time value of money, and the EMI trap. Now, you see, if I go to the market today and buy a basket of goods, it will probably cost me 1,000 rupees for my weekly requirement. But if I go to the same shop after a year, the shopkeeper will probably ask me for 1,050 or maybe 1,060. And if I give him only 1,000 rupees, then he will reduce a portion of the basket. So we all know that this is because of inflation. But the point which I am trying to make today here is, why does inflation happen? Or what are the types of inflation? Or if I may put it in a better way, I would say what are the aspects of inflation? Now to understand that, let us consider that you go to the market to buy some goods. Maybe fruits, vegetables, grocery, clothing, or whatever. Now, how does the goods come to the market? The goods are actually pushed into the market. And in doing so, there is an input cost involved. That input cost could be in the form of raw material, labor, the transportation cost, and such things. And on the other hand, the goods are pulled out of the market, pulled out by the demand from the people. Okay, now why does the cost of things change over a period of time? That may be because of either of the two reasons, like for example, the input cost may increase. Now today the cost of fuel, the cost of petrol is about 90 rupees a liter. Maybe by next year it may become 100 rupees a liter. So obviously the input cost will increase and therefore the cost of things in the market will increase. When the inflation happens because of the increase in the input cost, then it is called as cost push inflation. Now it may also happen that the input cost may remain the same, but the demand from the people may increase. Now why should the demand increase? Maybe because the people who are requiring those things have increased, the population increases, or maybe the quantum of goods which have come to the market is less. For example, this year the monsoon has been good, so there may be 1,000 tons of fruit in the market. Next year, if the monsoon is not so good, then probably there may only be 800 tons of fruit, and therefore whoever is willing to pay more will get it. So that is increase in price because of the increase in demand. Now when the inflation happens because of the increase in the input cost, then it is called as cost push inflation. And when it happens because of the increase in demand, then it is called as demand pull inflation. Now you may ask me that inflation is inflation. How does it matter to us? In any case, we are going to pay more. So how will it matter to us? You are right. Actually, if you are just a consumer or if you are a housewife, then probably it may not matter much. But if you are a businessman, or even if you are a salaried class person, and if you are investing your money in some goods or in some company manufacturing goods, then you will always want to invest your money in those products or in those companies making the products where the demand is increasing because of, or where the cost is increasing because of the increase in demand and not because of the increase in the input cost. Okay, so that will explain why we should be concerned about whether the inflation is cost push inflation or it is demand pull inflation. Now, once we understand what is inflation and how it is impacting us, then everybody would want to, invest their money, or they would want their money to grow to an extent that it should be able to at least meet the inflation. If I know that what I'm buying today for 1,000 rupees, by next year I'll have to pay 1,050 for that, then I would want my 1,000 rupees to at least grow to 1,050 rupees, and therefore I would want to invest my money. But when I talk of investment, or when you think of investment, a demon called risk will stare into your eyes. Whatever you want to invest in, if you want to invest in a property, somebody will come and tell you that investment in property is risky. If you want to invest in gold, some other person will tell you gold is very risky. If you want to invest in the stock market, people will say the share market is very risky. So what exactly this risk is? Now, before we try to understand what the risk is, we will try and understand some difference between savings and investment. And then only the concept of risk will become clear to us. Now, suppose you are saving some money. You are getting your salary and some portion of the salary remains unused at the end of the month. So that is your saving. Now, if you keep that saving at your home, what is 1,000 rupees today, by the end of next year, it will remain 1,000 rupees only. The face value will remain the same. But as we have seen, the purchase power would have reduced. The purchasing power of that 1,000 rupees will only be worth 950 or 940 or maybe 960 because of the inflation. Now, suppose you keep that money in your bank account. Then what happens is the bank will give you some interest, and the face value of your 1,000 rupees by the end of next year will become 1,050 rupees. But the purchasing power of that money will still remain 1,000 rupees. What you are able to buy today for 1,000 rupees, after the end of 1 year, you will be able to buy the same things with 1,050. Okay. Now suppose you invest that money in some asset. Could be property, could be gold, could be stock market, whatever. But 1,000 rupees, say, because it is a small amount, let us consider that you have invested that in a stock market. It could be anything. Now, can you tell me after 1 year, how much will your 1,000 rupees become? In the first two cases, we know for sure. In the first cases, we knew that 1,000 rupees will remain 1,000, but the purchasing power will reduce. In the second case, we know that 1,000 will become 1,050, but the purchasing power will remain 1,000. But in the third case, do you know how much will it become? No, we do not know. So what is the difference between the first two cases and the third case? The difference is, when you are saving your money, there is certainty. But in investment, there is no certainty. Your 1,000 rupees by the end of next year may become 500, may become 800, may become 1,200, 1,500, 1,800. We don't know. So that uncertainty is called as risk. Let us also consider some more differences between savings and investment, because what I have observed is that most of the time, most of us remain confused between savings and investment. Sometimes what we are saving, we consider that as investment. The first difference between saving and investment is that saving is a simple thing. It is static, your money remains where it is, and it gives you a diminishing return. But investment is not so simple. It is dynamic also, and it gives you a variable return. Your returns may increase, may decrease, and the increase or decrease is also not known in terms of quantity. Savings is basically non-utilization of your money. You are just keeping your money at some place, either in your locker or in the bank, but you are not utilizing that money. Whereas investment is putting that money to work. The money what you save in the bank puts it to work in terms of investment. It gives it to the businessman and then they grow the money. Saving is basically a subconscious compulsion. Actually, nobody wants to save money. But this is somehow drilled into our minds. It is ingrained into our minds that you have to save, because if you don't save, what will you do tomorrow? What will you do after your retirement? So that is a subconscious compulsion which makes us save money. But investment is a very conscious decision. You evaluate the pros and cons and then you invest your money. Another important thing is that savings is entirely your own. In fact, you can save money only if you own money. But investment can be done with borrowed money. I'm not advocating that you borrow money to invest, but the fact remains that the biggest of the biggest business, they borrow money from banks and they do their investment for their growth and expansion. But you would never have seen anybody borrowing money for the purpose of saving. For investment purpose, yes, it is advisable to borrow and invest. Another thing is savings give you a very goody-goody feeling that you have something with you. But when you invest your money, you are always worried. The demon called risk is always staring into your eyes. You are anxious whether your money is growing or it is diminishing. So that is the difference between savings and investment. And therefore, now we come back to risk. What is risk? Risk is nothing but the chances of something happening which you don't want to happen. Say, for example, you are climbing a staircase. Now, you don't want to stumble and fall down, but still there are chances, depending upon how steep the staircase is, how slippery the floor is, there are chances that you may tumble and fall down. And the probability of that happening something which you don't want to happen, that is called as risk. So what do we do? If there is risk in investment, should we invest or should we not invest? Now, before answering this question, before answering whether you should invest or not to invest, I would recommend that you should analyze the risk. But how do you analyze the risk? To analyze the risk, you ask yourself the following questions. Number one, what does my risk depend on? And then you ask, what is the implication of my risk? And after you have answered these two questions, then you ask yourself, is the risk worth taking? Now, more often than not, 99% of the time, it so happens that we ask the third question first. But unless we have answered the first two questions, there is no answer for the third question. So therefore, these questions must be asked in a sequence. And to answer these questions, you have got two options. Number one, you have to be logical and financially aware. If you are logically and financially aware, then you can answer these questions yourself. Otherwise, you may have to depend on a financial advisor. And my recommendation to you is that you yourself should get financially aware, and I'm sure everybody is logical enough. If you get little financially aware, then you will be able to answer these questions on investment by yourself. You will not have any need to go to any financial advisor. Now let us consider two practical cases of risk analysis. These are not related to finance, but first we will consider something not connected with the finance, and then we will try and correlate that with finance. Okay, consider this case where a lady is walking on a tight rope. Now, would you call this as risky? I'm sure you will all agree that this is risky. So if there is risk involved, then ask this question: what does the risk depend on? Now, in this case, I would say the risk depends on how well trained the lady is, whether she is walking with her eyes open or blindfolded, what is the level of her confidence, what is the wind condition, the training and confidence of the people who are holding the rope, the condition of the rope itself, at what height from the ground she is, whether it's 5 meter or 50 meter or 100 meter. So there can be so many things. And what is the implication of that risk? The implication is that if she falls down, she will either break her limbs or she may die. And therefore, now you ask the question, is the risk worth taking? Now, when you ask this question, the answers can be different. From the observer's perspective, from the perspective of her parents, her family, her children, they will say that the risk is not worth taking. But if you ask the lady herself, she knows her level of confidence, she knows her level of training, and she knows that once she reaches the other end, she may win a big prize, maybe 100 million pounds or 1,000 million pounds or whatever. If that be so, then she may consider that the risk is worth taking. Consider another case where a young girl, a young child, is cutting vegetables with a knife. Now, do you consider that risky? I'm sure you will agree with me. So again, ask the question, what does the risk depend on? Here, the risk would depend on how sharp the knife is, whether she is cutting the vegetables for the first time, whether she is doing it independently or under supervision, how soft the vegetables are, how sharp the knife is. So those are the conditions on which the risk will depend. And the implications is that she might cut her finger, bleed for some time, bandage, and that's about all. I don't visualize any risk to life or limb here. So now you ask the question, is the risk worth taking? Again, from the observer's point of view, you may say that the risk is not worth taking. But look at it from her parents' perspective, who may be wanting their child to train for future life. They may be training her child. So in the perspective of the parents, the risk may be worth taking. But again, these two risks are not the same. In one case, life and limb is involved. In other case, it is a matter of training. Now you try to correlate this with your financial decisions. Say you have about 5 lakh rupees with you and you want to invest that money. Maybe in the property, maybe gold, maybe say stock market. Let us consider you want to invest that money in the shares of an automobile company. Now you will have to again ask these questions. What does the risk depend on? So to answer that question, you will try to, you will see the balance sheet of the company. You will evaluate various parameters. You will see the government policies on automobiles. You will see who is the management of the company, various financial parameters like the P ratio, the book value, the current market price, the earning per EBITDA, and so many various things about, and those things are not very difficult to understand. You see, a balance sheet is very difficult to prepare, and therefore it is prepared by a chartered accountant. But to read the balance sheet and draw inferences from that, that is not very difficult, because the balance sheet is prepared for the common man. It is prepared by the chartered accountant, but it is prepared for the common man like you and me to read and understand some things from it. And if you have the basic financial knowledge, then you will be able to understand the parameters from that. And once you understand those parameters, then you will ask, what is the implication of the risk? Is my 5 lakh rupees likely to become 2.5 lakh rupees in 1 year? Or the risk is only about 50,000 rupees? You will try to, understand the implication, how risky that investment is. And then you will take a decision whether it is worth taking that risk or not. There are certain other aspects of risk also which we must understand. Something called as systematic risk and unsystematic risk. Don't get confused. This is not related to what you have seen on top of the screen. But now I'm going to explain that. Say you have invested your money in some property or stock market, wherever. And suddenly after a couple of months, there is a scenario of war. Now, if that happens, all investments will crash. The stock market will come down. The properties will crash. There will be losses everywhere. But can you do something about it? Can you do anything? No, you can't do anything. It is just fate accompli. You have to accept it. Or say, for example, if the government increases the income tax by 10%, can you do anything about it? It is across the board. It is for everybody. It has been increased for everybody, not specially for one person or a small group of person. Similarly, say the fuel cost, the petrol price increases from 90 rupees to 100 rupees. Everybody gets affected. So you can't do anything about it. So such type of risk which are due to macroeconomic conditions and where you cannot do much about it, those type of risk are called as systematic risk. So when there is a systematic risk, just relax and enjoy, absorb it, because you cannot do anything about it. But then there is something called as unsystematic risk also. Say, for example, you are driving a car and you go and bump into somebody's car from behind. Or say somebody else comes from behind and bumps into your car. So therefore you agree that driving is risky, but can you do something about it? Or could you have done something about it? Yes, in this case, you could have taken a comprehensive car insurance and thereby you could have mitigated the risk. Similarly, say if you have a petrol pump, you are owning a petrol pump in the marketplace, there are chances of fire. So what do you do to mitigate that risk? You take a fire insurance. Now, another example, like we all are growing old and we will need medical aid, medical assistance. We are likely to fall sick and various type of ailments. So can we do something about it to mitigate that risk? Yes, we can take a health insurance plan, but thereby we can mitigate that risk. Another thing, like you have say 50 lakh rupees and you want to invest somewhere. How can you mitigate the risk? By diversification. Some portion you invest in property, some you invest in gold, some you invest in stock market. So those are the measures you take to minimize or mitigate the risk. So those type of risk where you can do something to minimize the losses or mitigate the risk, those type of risk are called as unsystematic risk. So whenever you are facing a risk, you should try and club it under one of the two heads. If it is a systematic risk, just forget about it and enjoy. But if it is an unsystematic risk where you can do something, then you must take measures to mitigate that risk. Okay. Now, having understood what is risk and the risk analysis, Let us come to something which is called as liquidity. We have talked about purchasing power, inflation, investment, and risk, and now this is something called as liquidity. Now, have you tried to pour water from a bottle into a glass, or say wine from a bottle into a glass? You will be able to pour out till the last drop. But try doing the same thing with a sauce bottle. Though the entire bottle of sauce belongs to you, you will not be able to take out everything from it. And that explains, liquidity. In simple words, liquidity is how easily you can convert your own assets into money till the last rupee. For example, if you have cash in bank and you want to spend something, you just swipe your card and you can spend that money. So the money which is in your bank is absolutely liquid. You have some blue chip shares. Again, you can sell those shares and in 2 days the money comes into your account. So it is liquid. If you have gold, in banking terms, gold is considered as liquid. But if you are personally owning gold, then it may not be as liquid as your cash because it may take some time to, get it converted into cash. If it is a property, then it may take months or maybe years to sell it out and convert it into cash. So this is the aspect of liquidity. Whenever you are investing your money, you must give due importance to liquidity. Your money should be available to you whenever you require it. Then there is another aspect of liquidity which we normally ignore, which we don't consider, but it is very, very important. And that aspect is like one, I have told you how easily your own assets can be converted into money. And the second aspect is how easily and how much money is available in the overall market. Now, what do you mean by overall market? This is basically how much money is available in the economy. Now, this is controlled by the Reserve Bank. Often you would have heard that the Reserve Bank is either tightening the monetary policy or loosening the monetary policy by changing the various rates, the CRR rates, the interest rates, the repo rate, reverse repo rate. What exactly Reserve Bank is doing? It is actually controlling the liquidity in the market. Say, for example, the interest rates are brought down substantially. Loans are available easily to you and at very low interest rates. So what you will do, people will take loans, EMIs very easily, and they will do a lot of spending. Similarly, if the fixed deposit rates are very low, people will not put money in banks, but they would rather spend that money or invest that money in stock market and things like that. So therefore, there will be a lot of money in the environment. The liquidity in the market will increase. When more money is available in the market, people are able to take loan very easily. Then they will purchase more. So when they purchase more, the demand will increase. When the demand increases, the industries will produce more, they will manufacture more. When they manufacture more, then again their profits will increase, they will grow more, they will diversify, people will get employment, so there will be more money in the hands. The demand will increase further. But as we have seen in the initial slide, that when demand increases, the inflation will increase, the demand pull inflation will increase. And therefore, when inflation becomes more and uncontrollable, then again the Reserve Bank will come into picture and they will tighten the monetary policy. The interest rates will increase, loans will become difficult, so people will reduce their purchases. When people reduce their purchases, the demand will reduce. If the demand reduces, then the industry will produce less, so the industry will suffer. And when the industry starts suffering, of course, the inflation will come down, but the industry will also suffer. So when the industry suffers, again the Reserve Bank will come and they will relax the monetary policy. So this is a continuous process by the Reserve Bank. They will control the liquidity in the market. And therefore, when you are investing your money in anything, you must have one eye on the Reserve Bank policy. how is the Reserve Bank controlling liquidity in the market? And then you will be able, this is only a basic, awareness. As we go ahead in the next lectures, probably we will get into more details as to how it affects us and why we should keep an eye on that before doing our investments. Okay. Now, having understood the liquidity, let us talk of something called as time value of money. Now, I am sure you all would have heard of it, but let me explain to you in a little different manner. Now, suppose your client has to pay you 1 lakh rupees, but he comes and says that, I'm sorry, I don't have the money now. I will pay you after 1 year. Now, will you accept that offer? Without waiting for your answer, I would say that you will not accept that offer. But why not? You will not accept it because by now you are aware that the purchasing power of that money will not remain the same after 1 year. And therefore you will not accept it. You know that there is some inflation risk involved. Okay. You also know by now that there is an element of doubt. You are not sure whether he will really give it to you after 1 year, or he will tell you that, I'm sorry, I don't have it now. Again, you come after 1 more year. Okay. So that is called as the default risk. Your client may default. That probability is there, that risk is there. So therefore you will not agree to that. And you also have a doubt in your mind that if during this 1 year, if there is some emergency, if you require that money, will he give it to you in an emergency, or will he say that no, you have promised to take after 1 year, so please come after 1 year? That is called as the liquidity risk. Your money gets blocked for a year, so the liquidity risk is there. Then with this 1 lakh rupees which you are going to get now, you would have planned something. You would have planned some other purchases, maybe a holiday or whatever. You may have some plans for this 1 lakh rupees. All those plans will have to be postponed for 1 year till you get that money. That is called as the opportunity cost. The opportunity what you have now, you will have to postpone it for a year. But suppose he says that because of so much of risk and so much of compromises which you are required to make, I am willing to give you 20,000 rupees extra. I'll pay you 1.2 lakh instead of 1 lakh after 1 year. Now, will you accept the offer? Think over. You may accept, you may not accept. It depends. Now, suppose if this 1 lakh rupees you were going to keep in your bank or in your locker, and you feel that my bank was going to give me only 3%, 3.5%, or 4%. Here I am getting almost 20%. So in that case, you may agree. You may take the risk. You will evaluate, as we have discussed earlier. You will evaluate the pros and cons. You will decide how much risky, what is the nature of your client. Is he a reliable person? Is he having other businesses with you? So all those things you will evaluate, and then you may accept his offer. You may say, okay, 20,000 is good enough for me. I accept your proposal of taking it next year. But suppose if you are a businessman and you are confident that you can grow this money much more, then you will not accept the offer. You will say, no, please give it to me now. In 1 year, I will make this 1 lakh into maybe 1.4 lakh, 1.5 lakh, 1.8 lakh, depending on what business you have. So you may not, in that case, you may not accept that offer. So the question remains is, how much value do you expect from your money with the passage of time? Now, we have discussed that it will depend on how much risk you are willing to take. If you are not willing to take any risk, then you don't get any gain. You may keep your money at home and suffer inflation loss, or you may keep it in your savings account and just meet the inflation. If you are willing to take very little risk, then you may keep your money in a fixed deposit account. Remember that fixed deposit is also not risk free. It has a risk involved, though the risk is very, very small. But your money in fixed deposit is guaranteed only up to 1 lakh rupees, not beyond that. If you are willing to take little more risk, then you may invest in the corporate FDs. If the bank gives you about 6%, corporate FDs normally give you about 8, 9. Some corporate FDs give you 10% also. You're willing to take little more risk, then maybe you invest in debt mutual funds. Debt mutual funds normally give you about 8 to 10. Some give you 11, 12, 13% also. Some good debt funds give you. But if you are willing to take little more risk and also volatility, then you may invest in gold, because gold price, it keeps going up and down, but in the long run, it does go up. So your money may get locked for some time, maybe for a few years. You don't know how much. So if you are willing to take that risk, you may invest in gold. If you are willing to take very high default risk, then you may invest in some chit funds. They offer you interest up to 25%. Some offer even 30, 35% also. But a very high risk. You never know, one fine morning you get up and you find that those people have run away with your money. So if your risk appetite and your, risk analysis permits you, you may do that. If you are willing to accept market volatility and market risk, then you may invest your money in the stock market. The list can be endless, but what I am trying to explain here is that success will depend not on blindly taking the risk, but correctly analyzing the risk and then taking the risk. You have to understand the statement that no risk no gain and high risk high gain. Now high risk high gain does not mean that you take high risk and high returns are guaranteed to you. No, it doesn't mean like that. What it actually means is, if you are expecting high returns, then be prepared to take the risk. Be prepared to take high risk. And one more statement, as do not bite more than what you can chew. So therefore, risk analysis is very important. You take only that much risk, as much as you can afford. Most of the time what happens is, people take more risk, more than what they can tolerate, primarily because of lack of the basic knowledge and relying too much on financial advisors and information from friends and family and working on tips. So please do not do that. Before investing your money, please analyze your risk and bite only that much, as much as you can achieve. Now, having said that, let me come to the last portion of this presentation, and that is the EMI trap. This is something which is my I won't call it favorite, but I'm very concerned about this. Say, for example, you want to buy a car costing 5 lakh rupees, and you go to the bank or the car dealer and they offer you a loan at 12% interest for 5 years, and you have to pay an EMI of, the EMI will come down to 11,122 rupees. Now this EAR is the effective annual rate. Though the bank may tell you that it is 12% interest, but because it is compounded interest, its effective rate becomes 12.98%. Anyway, that is besides the point. But when you are paying an EMI of 11,122 per month, in 5 years you will pay 6,68,000 rupees. Okay. But the matter does not end here. Suppose instead of paying the EMI, if you were putting 11,122 rupees in a recurring deposit account in the bank, recurring deposit which is safe, unlike FD, recurring deposit is basically your savings account. It is safe. It is not an investment. It is basically a saving which is giving you some returns. So it works out to more than 7.5 lakh rupees. But suppose if you are willing to take some risk and invest your money for 5 years, 11,122 rupees per month, you are putting in a debt mutual fund. And a very conservative rate, I have taken 8.5%. Debt funds will give you from 8 to 12, 13% also, but I'm taking 8.5%. Still, it becomes 8.3 lakh rupees over a period of 5 years. Now, what am I trying to tell you here? Effective loan against a rupees 5 lakh rupees, how much you are paying? You are paying, effectively you are paying this much. Now, try and understand what I'm trying to tell you. I'm not trying to tell you, I understand the inflation 5 years back, the cost of living 5 years, all those mathematics, we'll keep it aside for the time being. I do understand that. But still, this much amount does not justify. I'll tell you why. You see, I'm not trying to tell you that you postpone your plan of purchasing the car by 5 years. No, never. I'm not trying to tell you that. What I'm trying to tell you is that if you wanted to buy a car today, you should have thought of it 5 years earlier. And if you had planned for it 5 years earlier, you would have had to pay only 6,717 rupees per month in a debt fund for the past 5 years. That would have given you 5 lakh rupees today to buy a car. Or if you had invested that money in a recurring deposit account, then you would have had to put only 7,000 rupees a month and you would have been able to buy a car now. Try and understand that this amount of 11,122 rupees which you are paying as EMI, it is actually your saving. You are saving it from your salary and you are paying an EMI. With this 11,122 rupees, you can either save or you can invest. If you are saving this money, if you are giving the EMI, then you are not able to invest. And if you are not able to invest, what will happen? After 5 years, this EMI will be over. But since you have made no investment, you will again require money after 5 years and you will get into another EMI trap. And by the time that EMI finishes, you will require another EMI. But if you can plan, 5 years earlier, just a one-time planning required. Had you planned 5 years earlier, you would have been investing this amount and now you would have got 5 lakh rupees. And since you will not be paying future EMIs, you will be investing this money. 11,122 you would be investing. And this investment after 5 years will become this much. And you will utilize this investment and again start an investment for your next purchase. Another way of understanding this is, the bank is asking you to give an EMI of 11,122 rupees. But if you go and tell the bank, okay, I am giving you 5 lakh rupees now, will you give me 11,122 rupees every month for the next 5 years? The bank will not agree to that. So that itself shows that, the bank is doing a business on you. So my advice to people is that please do not fall into the trap of EMI. EMI sounds good. Taking loan sounds good if it is for an investment purpose, if it is for a business purpose. Suppose this car is not yours, but it is for the company, for your company, and you are getting some tax rebate and depreciation benefits and all, then by all means you go for EMI. But if it is for your personal use, then EMI is not the right thing. Borrowing money for consumption is bad, but borrowing money for a business is fine. That is all right. This is my last slide. These are the basic 6 principles of finance. The principle of risk and return, we have discussed it briefly. The profitability and liquidity also briefly we have discussed. Time value of money also we have briefly discussed. And the principle of diversification also we have discussed briefly. Probably in the next lecture when we do something more advanced, we will be talking about these things in more details. Then there is something called as cash flow principle and the principle of hedging. This is primarily applicable in the stock market. So maybe in subsequent lectures, we will talk about these things. Now, these are, some of our financial awareness programs which I keep conducting on and off. My aim is actually to spread the financial awareness. You should be able to take your own financial decisions. There should be no need of, entrusting your money to somebody else and somebody else takes your financial decisions. So these are some of the programs. If you, whenever we do in the future, if you get acquainted with the things, even in the like the stock market, investing in mutual funds, trading in derivatives, most of the time in my previous webinars also, people have told me that Colonel Shahid, we are not interested in learning. We don't have time. We are not keen to learn. You just tell us where to put the money so that the money will grow. Now, I really don't have answers for this. If there is no fixed answer which will, there is no fixed size which will fit all. Everybody has got a different perspective, different risk appetite, different requirement. You may have your children at different ages who will require money at different stages of life for their education, for their marriage. The requirement of every individual is different. So there cannot be a fixed formula which will fit everyone, that you invest so much in this, so much in this, and so much in that, and that is about all. It doesn't happen like that. So my advice is you should become financially aware, learn about these basic things. If you are interested in investing your money in the stock market and mutual funds, learn about that first. And then you will be able to take your own decisions, wise decisions. You will not have to depend on tips and speculation from other people. So that is all what I have to say.